Hello and welcome. You're watching Market Drop, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICIdirect. A very good afternoon, Pankaj, and you are a happy man today, right?
Yeah, absolutely, absolutely. With Nifty at the 52-week high, definitely I'm very happy.
Mhm.
I think overall, Indian markets have got a good boost, especially from the US inflation data coming out to be a lot more softer than anticipated. And as
Mhm.
a result of that, we have seen about 30 bips kind of a decline in most of the major 10-year US yields. And obviously that has implications domestically because one, I think it will have a positive rub on IT stocks, which is what got reflected today.
Mhm.
And the other thing is that overall it is beneficial for inflows. So again, banking and financial services, another sector which will see rub off going forward. So I think two of the major heavyweights of the index
Mhm.
get a positive boost from this particular news, and which is why I think Nifty is at 52-week high, and I'm happy.
Mhm. You rightly said Nifty at 52-week high, Sensex at 52-week high, IT index up 3% for the week, Nifty Bank index up 2% for the week. Metals are also recovering from the lows. And as you rightly said, that inflation numbers from US really propelled the market higher, and the global indices were also, closed higher. And that was followed by the move in the Asian markets and our Indian markets as well. But Pankaj, we all know that Fed isn't done as yet. There is more hike to come for sure. So why this euphoria?
Absolutely. So it is premature to expect that you will not see hikes in December and you'll not see subsequent hikes. But I think what it does is that up till now, the Fed has been aggressively hiking rates, and we haven't seen inflation sort of cooling off materially. This is
Hmm.
the first time we are seeing inflation below 8% for, I think, in the past 8 odd months
Hmm.
after hitting a high of about 9.1%. So, somewhere down the line, the overall rate hikes have started to have an impact on the overall inflation numbers, and subsequently going forward also, if the inflation reading comes lower, then somewhere down the line Fed will have to take into that consideration, and the expectation that you will see higher rates for a longer period of time, I think probably will sort of could change its course. And I think there are major fears now, which were sort of there in the market globally. One was obviously the inflation fear, and then you
Hmm.
had the recession fear. Now, inflation fear is sort of coming down, and I think recession fear is still sort of there because if you are aggressively hiking it, so somewhere down the line, I think Fed will have to maintain a balance between the two. But
Okay.
I think this is a sort of a good print on inflation, what we have seen. And as a result of that, we have seen dollar index tracking down. I think it's domestic volatility when we sort of see is at a 6 month low. IT index has given a breakout after a period of say 11 months. Nifty
Hmm.
itself has given a breakout after say 13 months. So all
Hmm.
in all, it has sort of ignited all the positives in the market further. So,
Hmm.
and our sense is that with that in perspective, we are headed for a new lifetime high from 52-week high. And after that, probably 18,900 is what we would look. So so next year looks a lot more constructive from overall market perspective.
But that's what the markets say, Pankaj. But if we go by the rating agency's latest data, they say that India might grow by 7% in the calendar year 2022 and the fiscal 2023. But the growth may slow down to sub 5 level in financial year FY24. Will you buy that thing, what rating agencies are saying right now?
So there is nothing wrong in rating agencies projecting a lower growth because obviously since we are part of the global economy, if there is a global slowdown anticipated, obviously we'll also get impacted, and which
Hmm.
is why are some of the global exposure sectors have been impacted, be it pharma, be it IT, and number
Hmm.
of other sectors, say for example textile. So, but one needs to sort of look at it from two perspectives. One is, say, GDP growth rate is all lagging indicators. So basically, the event has already happened, and then you sort of look at what is the growth which has come by. I think when you sort of look at, say, for example, market is largely more forward-leaning in nature. So, which is where, say, for example, if there is a commodity prices or wholesale prices have started to sort of correct, then you would sort of want to believe that somewhere down the line it will get reflected in CPI numbers. I mean, in take the example in US itself. I mean, when you sort of see, say, car and truck prices, which had sort of driven previous inflation, what we have seen is that there the inflation has come down to about 2%. So overall, the trajectory is what matters, and that is what market looks more consciously rather than sort of looking at a lagging indicator. I mean, a case in point can be, say, for a cement as overall sector, this is the worst quarter what we have seen. But we also know that the raw material prices have corrected by 25-30%, which has been the biggest pain. So you'll see recovery from their levels, and which is why you're seeing a sort of appreciation in cement prices. So I think market is more of a forward-leaning in nature. Typically, a lot of these GDP numbers are sort of lagging indicators, and which is why they are looked at it more from a confirmation rather than as a direction basis.
Will it be right to say, Pankaj, that worst is over for IT space and it's time to really now accumulate the best names in this sector?
Absolutely. So we would want to believe that the worst of the global macros is probably behind us. And which is why if there is improvement anticipated globally, then I think technology stocks obviously should get preferred. And our sense is that this is one sector which has been sort of beaten down quite substantially, beat large caps, beat mid caps. And which is why I feel that tier one companies like, say, for example, Infosys, there we have a target price of 1670. Now, this company is looking at a 15% constant currency kind of a growth. And there are a number of levers which are working for whole set of companies. One, the subcontracting cost has been higher for a lot of these companies, which is expected to sort of come down with the overall job scenario panning out domestically and globally. Because we are seeing decent amount of job cuts being announced. The other factor is obviously the overall deal wins have been good, and then attrition is expected to sort of come down because and also the fact that companies have been hiring more of freshers, and they'll start to sort of build these freshers going forward. And which is why Infosys, even HCL Tech looks good to us, largely similar template. Here, the growth rate is a bit higher at about 16-17% kind of a constant currency growth rate. And multiple wise, it's about 18 times. Here, our target price is 1115. And Coforge is another company which we have been liking. This is a company which has got the least attrition of about 16 odd percent, far lower than what you see for most of the players. And then they are expected to hit $1 billion kind of a revenue this year and about 2 billion in the next 4-5 years. So I think it is time to look at least tier one IT names, given the fact that we are sensing improvement in global macros.
Pankaj, now that we have some kind of a good news as far as the on the inflation front is concerned from the US, the interest rate differential narrowing that was seen between India and US, that may halt a bit and may come down in with time to come. Will that benefit the banking space? Because banking sector has been overweight as far as the FIIs are concerned. They have major exposure in banks. Still, they're holding some of the good names in the banking space. So if the FII money starts flowing back into India, will the banking sector be the main sector where we can see good flow as far as the FIIs are concerned?
So I think two things here. One is I think we are, when we sort of look at the commentary from the RBI, largely it's not that we are chasing or we are hiking interest rate because US has been sort of hiking rates. I think our inflation trajectory is different from US. Our composition is different. So for example, for us, 40-45% is the food as an overall input for our inflation. Monsoon has been good for the fourth year. Winter crop is also expected to be good, which is why we are not going to follow the similar trajectory of what the US does. I think where we are going to see a lot more benefit is the overall inflows, because once if US continues to sort of remain under pressure, then obviously the yields will be higher, and as a result of that, the fixed income there looks attractive. But overall, if the interest rate hike does not follow the similar trajectory, then I think it is good for overall inflows. And banks are obviously a good place to sort of park your money, especially from FI perspective. You've seen the banks losing the maximum amount of FI outflows. Or
Right.
contributing maximum to the FI outflow. So from that perspective, overall banking as a segment looks very attractive to us.
So which are the banking stocks that you're betting on now?
So I think larger banks, largely because FI exposure is there higher. I think HDFC Bank has got a good boost. In fact, this particular week, if you look at bulk of the gains in Nifty has been driven by HDFC Twins because I think there was some tweaking by or announcement by MSCI which come by. Now, as a result of that, while HDFC was part of the MSCI, HDFC Bank was not because of the lower FI headroom. Now they've
Okay.
sort of tweaked the rules. So now from 6%, the combined entity can have a weightage of about 14 odd percent. So obviously,
Mhm.
HDFC Bank has been coming out with good set of numbers. So that is one bank which can be looked at. Here, our target price is 1600. Axis Bank, good set of numbers, 852 target price. And SBI again, 600, the target price there is 700. Now, all the three banks, or in general, if you look at banks, they have reported one of the best profits in this particular
Yes.
quarter, about 38,000 odd crores. So this is the highest ever profit being reported. Generally, what is expected is that the spreads are going to be better because
Mhm.
transmission on the lending side has already happened. On the deposit side, it is yet to happen, and credit growth is good. There are no major asset quality concerns. So banking obviously is looking a good place to be from if one is looking at the FI inflows, and in the anticipation of that, yes, banking is looking structurally positive.
Mhm. Pankaj, what is your take on the auto space? We had numbers from Tata Motors, we had numbers from Eicher Motors, Ashok Leyland. Uh, did you really like the numbers?
So overall, if you look at mixed set of numbers, I mean, Tata Motors numbers were subdued, Eicher Motor numbers were good, whereas Ashok Leyland or even M&M numbers which have come out are having sort of steady set of numbers. So it's sort of a mixed bag kind of a performance. Now, when I sort of come to individually, when you look at say Tata Motors, obviously GLR is impacted. It's a sort of a no secret. I think what is sort of disheartening was that the FCF guidance what the company had given of about £1 billion. I think they
Mhm.
have said that that will not happen, and as a result of that, the kind of debt reduction which was anticipated is not going to happen. And
Mhm.
you will still not see sequential growth in JLR volumes, and that could happen only in Q4. So, which is why it is a bit of a disappointment, and we had to sort of downgrade it to hold. Aisha
Okay.
Motors, I think, good set of numbers. Hunter is sort of contributing very well to their volumes.
Mhm.
While it's a slightly lower margin kind of a product, but overall the volumes are very steady. Our sense is that iShares will clock higher volumes in FY23, so they'll register the peak volume or the highest volume this particular year. And
Okay.
again, on top of it, you'll see better growth even in FY24. And CV has been sort of better, so they have got the better margins in CV side. So I think Aisha Motors is looking very good to us with a target price of 4310. Ashok
Mhm.
Leyland numbers were sort of steady, so 6% kind of a margins. And not much of a surprise is what I would say. Well, numbers were
Okay.
largely in line. CV cycle
Mhm.
is expected to remain robust,
Mhm.
and which is why we are maintaining with a target price of 180.
Mhm. Pankaj, you have always been positive on the CRAM space, be it for the chemical companies and be it for the pharma companies. How do you see this space panning out as far as both the sectors are concerned?
So when you sort of look at CRAMS companies, there are some companies which have been doing exceptionally well. There are some pockets where there is a sort of a disappointment. Now, when we sort of look at most of the chemical CRAM companies have reported a stellar set of numbers, largely driven by the higher capex execution, what they have done, and the
Mhm.
higher order book. And so, case in point being PI Industries. I mean, this company has grown 30%, witnessed 30% growth in their CRAMs. and CRAMS is contributing, say, about 75% of the overall top line. The order book here also is sort of increased substantially from $1.4 billion to about $1.8 billion. They're guiding for 20% kind of a growth. And largely their CRAMS is mostly agrochemical CRAMS. So which is why then when you sort of look at another company, say Neogen Chemicals, which is into bromine and lithium based chemicals, they derive about 25-30% of their revenues from CRAMS. They also reported 30% growth. They have been witnessing higher customer inquiries. So overall, the prospects on the agrochemical CRAMS is very good. Now, there's some
Okay.
pockets, say, for example, DVs, which has been impacted. So CRAMS for them was soft, largely because up till now, last 2 years, global players have been focusing more on COVID-related products. So COVID-related CRAMS was taking or was sort of garnering or was driving revenues. Now there is a shift in template, so now they're going back to old template. But what we see interesting is that the kind of inquiries what they're getting, and these inquiries, our sense is that would get converted into orders in subsequent quarters. But the revenue for that will flow somewhere, say 4 to 6 quarters down the line. So which is why it is still a sort of a bit of a long walk from that perspective. But overall, CRAMS space is looking good. I think agrochemical CRAMS is looking quite brighter. I think the pharmaceutical CRAMS will take some time to sort of perform. So I think there, but overall things are shaping up quite interestingly well in the overall CRAMS space.
Markets are definitely holding up, and Pankaj's list of hidden stocks is extending, and it's getting more and more stocks are being added to the hidden gem section, which Pankaj gives on weekly basis. So, which is the stock that we are going to talk about today, Pankaj?
So I think since IT and banking has been the flavor, so IT is what I would prefer because this is one sector which hasn't sort of really performed for quite some time. So for this, what I'm sort of putting as a hidden gem, here our target price is 4,570. So we are valuing at about 24 times FY25. This is one company which is guiding one of the highest growth, is very confident about achieving 20% constant currency growth. They've been growing at 5% growth in the last 4 quarters. So pretty steady growth is what they're delivering. This year, they'll be achieving about $1 billion in sales. By FY20, in next 5 years, they're expecting this number to be about $2 billion. The order intake has been good. So they've been getting orders of in excess of $300 million in the past 3-4 consecutive quarters, and which again provides a good visibility. And I already highlighted that they have got the one of the least attrition. I think they were quite considerate even during the COVID time, probably, which is helping them retaining their employees in a situation like this. And
Right.
they've been guiding for a pretty steady or good margin of 18.5 to 19%. So, which is why we feel this company is looking good. And in general, IT as overall pack is looking a lot more brighter now.
So, hidden gem for this week is Coforge for target of 4,570. Pankaj, now, if as far as the earnings are concerned, more or less they are over. So, what are the big triggers that you'll be watching out for next week, and what is the range that you expect the Nifty to play out?
So one is we don't expect Nifty to breach 17,800 levels. So I think any kind of a bit of a profit taking is a buying opportunity. Our sense is that market is headed towards new highs of 18,600, and subsequently it will scale up to 18,900 kind of a levels. And this is going to be driven by banking and technology for reasons which I highlighted today. And I think if overall US inflation trajectory is going to be good, then I think we are from 52-week high, we will go towards lifetime high in Nifty. And you could still see some stock specific reaction as and when we digest the entire set of results, because last 2-3 days, I think you have massive set of numbers coming out. So obviously, not everybody would be able to grasp all set of numbers. So you'll still see stock-specific action panning out even in next week for some of the companies.
Thank you, Pankaj, for your time and for your view on the markets. Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.